Okay, let me just go back quickly because I was skipped the recording, so we are still in the beginning. Welcome back. So we're gonna apply the one Excel working model illustration as a understanding for the Ministerial Decision 173, the tax depreciation. So the tax depreciation is also the important learning. We covered today topic by theoretically with some example. Now we're gonna cover the tax depreciation, the model itself. We try to build one the Excel integrated model in which we covered the 5 example different kind of properties. So in which the objective or the purpose of this model is already mentioned, is written there here. If anybody want to get these models, they can approach us. We can share the same. So here we're seeing the prerequisite is the investment property, uh, as per the IS 40, and it should be on fair value and it should be recorded on the realization basis. Why is required? Why we are doing this for the tax depreciation? Our whole perspective is the tax depreciation. While coming to the this, we are looking for the tax depreciation. So as the output of this working, what we will give the city adjustment, how much we have to make in the city return adjustment, tax written down value forward, deferred tax, because of course when we do this calculation, there will be a deferred tax asset as well as the deferred tax liability also. Disposal clawback means if whatever the depreciation we deducted in the as per the Ministerial Decision 173, it will be a clawback means taxable in the year of sale. So we have to calculate that. So now we're gonna jump the input. Input is the same we are understanding. So as per the current data, we are current illustration. We have the model for 2025 as the current illustration perspective. Tax period are model 2025. Okay, input. This is the below fields are the manual input from the actual scenario that you have. You keep add over here, and moving forward, system will take the calculation automatically. So here we are saying the current tax period, because this is our first tax period. Means the first tax period when we gonna start this calculation, we are saying in 2025 tax rate is this. Income threshold is this, tax depreciation is 4%. As per this, it will remain same, no change. Then next is the assessment or the prerequisite. We have to look into that. The realization basis election is made as per Article 20 of the city law. Yes or no? If we made, is good. If we not, if we made, then we have to go to the next. The ministerial decision 173, if we opt, we are looking to opt or not. If we are looking to opt, we have to see our investment property held at fair value or no. Okay, we are assuming that both are yes, so we made yes. So this is the assessment one, because we cannot go and apply on any item or any property. So that's why we added this information, and the same information or the same ministerial decision key points we learned today, and we are applying over here. The accounting basis, the accrual basis, as an exception, some industry may follow the cash basis, then it will not applicable. Then the next is the accounting model, the measurement model. Its property should be categorized as the investment property as per investment property IS 40. Then the second prerequisite, it's because the fair value, it might come on the investment property come on the cost or the fair value. There is a possibility, but if we would like to go for the ministerial decision, we have to see its fair value. The starting date, these are the actual dates, first tax period of depreciation, disposal, in which year we sold. So now this illustration data, we make some dummy data, some practical cases where we given the different type of property as a scenario. We said they may be the same company, LLC company. They have the 5 properties. First property, the residential building. Second is the commercial. Then they have retail mall, warehouse. Okay, then hotel property. Then here is the original the transaction the transaction value, original cost, the transaction value. Of course, the date of the purchase also will be there, and this is the year-end figures. We can say the year-end, at the each year-end, what are the closing balances of that property. So we may start the scenario from 20 till 2030, and different step by step we calculate the figure. This is the actual. This came up, and this is the calculation. This is the fair value, because the fair value comes from the valuation. So that we assume that these are the fair value of each year. Okay. So now we come to the next tab, that is our property register. So yes, you might keep in the same fashion as a we shared sample, or might you have any other template. Important is that some important information we must keep. But here we written the property ID. So normally practically here we can write the Makani ID. The Makani ID is issued by the government. Reference to the each property, that is called the Makani ID. Okay, because that is the on each we've seen in the our rental contract, HRE is also mentioned the Makani ID when we sign the contract for office warehouse. So the government given one unique identification number to that property. So it will be that proper Makani number. Okay, so now the property name is different kind of properties. This is the type is mentioned, and the date of purchase is assumed over here. Original cost is here, and the opening value of each is all written over here, right? So opening value. So this figure opening value we already learned in today's topic. The opening value means the tax written down value. We are considering written down value. How to calculate that also we learned in the today topic. That is a separate recording is available. If anybody interested, he can search that previous session. Now this table we already plotted, considering one particular scenario. Even you put the value in this table, automatically the figure will be calculated. So now we assume that the asset is kept with us till 2029, and they will be disposed in 2030. And if we have the disposal proceed is this 16 million, 35 million, 65 million, and we follow the IS 40, and we opted the realization basis. This is the check before moving to the next step. Then the next sale decision 173 is followed. Yes. Then we are eligible. Yes. Annual depreciation is charged. How much depreciation is charged so far? Total depreciation charge is this. From this period to this period means for up to 4 years. What is it? This is the per year depreciation per year, and this is the total. Okay. This is the annual means yearly, and this is total for the period. So how much depreciation is charged? So now deferred gain to 2029. So this is the deferred gains. So how is calculated the deferred tax gain? That also we will look into that. If you want to understand, here the formula. Okay. So the formula is, you can understand, H. Okay. The H minus original price or original cost. Okay. So far, how much the deferral gain? Because each year the deferral gain will be excluded from the taxable income. Already there in our accounting, but we're going to exclude because we opt for the realization basis, and tax depreciation is not recorded in our accounting figure that we have to record. So if you have this accounting model, so you can go back and see how these figures are come up. So what is the deferral gain? The original cost. So the original cost and the where is it? This is so H minus E means this is the closing balance at before the sale, the final year, right? And how much the increase in value. We are taking the we are calculating this, but every year it has to be. Like in 24, how much the deferral gain? 1.8 million. and here is 2, and here is 3, right? So if we add 1 by 1, then it will become the 5 million. This is the understanding I'm writing here. From here to here, 1.8 million. From here to here, 200K. From here to here is 3 million. So total 1.8 plus 200, 2 million plus 3, 5 million. So this is the 5 million figures. So in the same fashion, if you go to the below example, the same calculation is there. So this is the property register. Now we are looking the recategorize or redesign as per the investment property application. As per investment property application, just for better understanding, here they shown the profit and loss, gain and losses recorded, and these gain and losses, how it will be affecting. Let's see the first property we purchased. First property, this is original cost. This is the closing. All these are the closing. December. We are assuming this same, right? So let's say the first year. The first year we have the gain of 200. We have 200. Why? Because from date of purchase until date of till year end. Sorry, till year end is 200 is the gain. But of course, our books will be continue from here onward, because we purchase and year end in our books will be value shown as this, right? So during the year, of course, when you compute the taxable income, this 200 will be excluded. But as an example, we are looking the scenario if, because here is not we computed this 2020, but we can add also here 2020. But we can add here 2020. So how it will be? So it will be the two, like this is the 21. If let's say I'm making the 2020, so how much the gain will be? 200, right? Okay, let's see the example starting from here. Let's see the example starting from here. Okay, let's see the example. Just take this 10 million, 10.5 million minus 10.2 million. How much the gains? What is this? Because this property we are already discussed at fair value. So increase in value is fair value. So this is the gain of 300 in 2021. How? Because in year 2020, the opening value of the asset was 10.2 million and the closing balance is 10.5 million. So this is the gain. Same way, the next property, the closing balance in 2020. See here, if you focus, this is the 2020 closing balance. The closing balance means here the charge, the gain. This is the balance sheet. This is, we can say these are the balance sheet items and this is the P&L item. So in balance sheet, value is shown is the 10.5, right? And the opening is 10.2. The difference is 300. So it's already recorded here. The second effect of this 300 is went into the P&L. So this is the 300 gain. So now because we opted for the realization basis and this is the unrealized gain, so this gain will be excluded gain. So this we have to minus from our city computation because it's already added in our accounting profit. The accounting profit we already added. Now we're gonna minus. So one by one, this to this, 500. 25.5, 26 million. From here to here, 15 million. From here to here, 200. From here to here, 400. So this is all the calculation. I'm just explaining this how it works and what is the understanding. But although the Excel is already integrated or prepared in the same fashion. Let's go to the next our tab, in which we're gonna apply the tax depreciation. That is our main agenda of learning. But of course, all the previous expected step is also important. So same original cost, eligibility, opening value of tax depreciation is this. What is it? Tax return on value, and we are assuming that both are same. But as we learn that here, the question may come, okay, we have to exclude the depreciation for previous year. Yes, we can calculate and minus from here. Whatever the actual period, we can minus. But here we assuming that the original cost and both are same. But actually, one step is missing here. The depreciation before first tax period is missing. Okay. So that is the additional working that you have to work into that and make up to date. What is the missing? The depreciation from date of purchase till the before the 1st Jan 2025. Okay, December 2024 based on the scenario. So the 5-year depreciation have to be excluded here, but that is not relevant for us. But the calculation is important. So here we are assuming original cost and tax return on value both are same, but actually the 5-year depreciation will be minus. So then it will become, so let me add the one more. This one add here. You can also the parallel with me. Okay. The depreciation, so before tax period depreciation. How are we going to calculate? So we already have the depreciation per year. If we go here, we already seen the depreciation charts. I'm already seeing the depreciation chart. Yeah. So here is already calculated the depreciation, right? So this is the, but this is the afterward, not before that. So let's take this is the yearly depreciation. We what is the duration? So we kept from all the same element. This is 1st January, right? 2020. So if we calculate up to here, so how many years? 5 years. 20. We can count 2020, 21, 22, 23, 24. 1, 2, 3, 4, 5. So 5 years. So when we come here, so what we're gonna do that? We will say, okay, multiply by 5. Right? So if we apply the same formula up to here, so our depreciation before first tax base is ready. So now if we upgrade our assumption, so this part was missing, so now we update it. Right? We kept this element because while come online session, so we will understand practically with example. So any question there? Any question there? Adnan is here with us. Amir is there. Ilfam is there. Prabhu is there. Okay. Any question on? Well, if you understand today's session and this exercise, so this one of the exercise or working is ready with you. Okay, let's continue with that. So this depreciation we applied, and now this file I will not share. You have to adjust the same addition, whatever the addition we are sharing over here. Why? Because this is the objective of the learning while come with the online. Okay, the rest everything is coming. How this coming? Okay. You click on the formula, it will be appearing, right? Original cost minus depreciation before first tax period. This is the opening value of this. So whatever the opening means, the previous year is closing. So depreciation 2025. Okay, so this is previous year and this is the current year depreciation. Current year depreciation, this is the closing. The same normal accounting method what we are doing. So this is the closing, this is the 26 depreciation, closing of 26. Same way it will be continue till the our working. So now closing tax return on value is shown over here. Total depreciation, whatever we charge is shown over here from this period. Then the next is the clawback. So this depreciation that we are deducting, which means we are not paying the tax, So this will be taxable in the year of sale. So this is called temporary difference. Means the cash flow management. We are not paying tax on these amounts as a relief allowed by the tax authorities, by FTA or the ministry. They said, okay, in the year of sale, you can pay. Okay. Because in the year of sale, we will have the cash. If we have the cash, so then from that, we can pay out this money also. The clawback mean taxable. Here was the, we excluded from our calculation here, reverse that calculation. Okay. But if we are doing here, so what we are building, deferred tax liability. We might heard the concept of deferred tax asset. And in this case, we are building the deferred tax liability. Why? Because this deduction will become taxable in future. So whatever the amount, the another learning we will record in the same amount, the same amount let's say is recorded, is deducted in the profit and loss, 2 million. Of course, you will say, okay, where is the second effect? Right? On the other side, because we charge the tax depreciation, not the accounting depreciation, in our books, the value is not getting to reduce. So if we debit this, so what is our credit? So deferred tax liability will be the same amount in the balance sheet, will be shown as a credit. Now in our accounting, it not shown, but I'm giving you the understanding. Outside the accounting books, you will keep monitor this. Okay, you will keep monitor this, and of course, if you opted and you did the proper disclosure, the auditor will accept this treatment and he will incorporate in your books as well. Okay, as a disclosure. Why? Because he's following the IFRS. And this treatment is not as per IFRS, but as a disclosure, because he has to calculate he is mostly the auditor now, they start asking the computation of the taxable income. So it will be continue affecting. So he might add as a disclosure into the financial. Okay, they opted the realization basis, and under the realization basis, they opted the ministerial decision also. So in this way, we will keep track. So this credit, okay, this credit means the tax liability. It will be offset in this year. In the year of sale, this all will become taxable. Why? Means how it will be reversed. Just assume that. So this deferred tax liability will be debit, and this profit and loss with the same amount, 2 million, will be credit. right? Entry is correct. Is this adjustment entry is correct? Yes, Amir. Okay. So we are charging here and reversing. This is the clawback. We also understand it will become taxable in the year of sale. So here is the adjustment, the same adjustment that we are discussing how to make the adjustment, because mostly in trainings and in seminars, uh, the concept they explain, but due to time limitation, they are not coming as a practical example. So here we try to build the practical example also. Here in 2025, okay, accounting gain recognizes this much, okay, and the unrealized gain, as we have to exclude this. First, we calculate it, okay, then how much the adjustment in the CT computation, the return computation, as the deduction is the same. First, we have to understand the gain, then deduction, then the depreciation, okay. This gain we are what you call it, is already taxable, we minus because we are not paying tax, and there is no depreciation, but law is saying allow depreciation, so this is the depreciation we minus. From where is coming 4% of this, okay. So this is the calculation is sharing over here. So now the next is as deferred tax gain taxable. So there is a two things that will be add back. One, this we are excluding, this we are minusing, right? So this add back. Now look in which year? In which year? This is the yearly basis, and this is the annual in the year of sale. So keep focus here also. This is the yearly adjustment. Okay, yearly adjustment that we can go back and check this calculation is coming correct from the previous years. Okay, and the year of disposal. So what is the gain that previously we calculated? So this will be taxable. Okay, that we will go and see what is the figure. So all the gains previously, how, because see the gain was in accounting we added, but in tax we minus. So whatever we minus from here in the disposal we are adding over here, right? Okay, now the depreciation is the here. So this all depreciation in the year of sale, it will be taxable. So this is the gain is here is taxable, right? Calculation coming back, any other adjustment to add back to tax deduct. But our point we already tested here, we tested here. So total income before threshold, assuming that there is no other item, so is minus 8 million. Of course, he will, if we go in this way, he will categorize as a loss, and loss can be carried forward for the uh, loss can be carried forward for unlimited. There is no expiry date of the loss. So these are the other calculation assumption. Everything is added over here. So deferred tax as the output of this. So output of this calculation and application, as mentioned, the deferred tax asset will be recognized. Deferred tax asset. And the other important factor we said, these are the temporary difference. These are the temporary difference. The temporary difference. Why? Because in the year of sale will be taxable. Any questions so far? And disposal is this. And disposal, everything will be. Sale proceeds, original cost, tax return on value, actual depreciation, gains. This I think already we covered. This is another way of presentation. Add back. See what is saying add back. The same depreciation is saying add back. Taxable. And 2030 in the year of sale. Will pay tax in 2030 on sale. So this is the net realization value is here. Net tax realization value. So that also you can check the formulas over here. It's already how these figures are getting calculated. Deferred tax gain plus the clawback, right? So this is the previously we excluded. Now we are adding over there. Okay. The scenario based analysis, no election realization basis. So these are the three. First, they said, okay, no election is made, no realization. Okay, what is the impact? Okay, no realization, no ministerial decision 173. Accounting profit before tax is the same. We will pay the tax on that. Okay. Now realization basis is opted, but no ministerial decision 173. Accounting profit will remain same. Yeah, realization basis. Yeah, realization basis. We minus the this accounting. The gain. Let me rephrase this. Because this is the whole concept, or this is the whole idea that we have to focus and learn. The same property, everything is the same. Other scenario, assuming that everything is matched. But what is our decision? What we choose is the as a taxable person, as the entity, as a client, as a consultant. What are the treatment that we opted? The treatment means the same property that have eligibility of all, but we opted. We said no realization basis. No realization basis. Of course, if there is no realization basis, this option will not appear, right? The first point, if this is not there, next option is not available. So let's assume no realization basis, no ministerial decision. In accounting profit, all the gain is taxable. What does that mean? We are paying the 9% of this. How much the 9%? Just imagine we are paying this tax in our first tax period. 396,000 we are paying the tax to the government. Why? Because we didn't do the proper or the appropriate tax assessment. We didn't do the planning. We did not understand the implication of tax on LLC entity, LLC company. Yes, you have the right to make no election, but on the same side, you have the look for which one is good for your organization. Okay, the next point, we are saying, okay, we did the election, realization basis. The guy is good, he opts for the realization basis. Now, because he understands, he's familiar, but now during 2025, ministerial decision 173 came, he's not familiar with this. This is the another we can say the market practice. The people learn the text or they read the text or whatever they taken the course one time in 2024 or 2023 or 2020 wherever. So let's assume he not follow the text update, what is called CPD. In all professional courses or the studies like ACCA, CA, ICW, CPA, all the courses, they come very common concept. Even the medical science or any engineering also, they call the CPD, continuous professional development. New amendment, new legislation, and new techniques are coming. So keep up to date with that. Okay. So one of that, the now if we have the AI and if we do not familiar with AI, so that also is lack of the CPD. With AI also we considering continuous professional development in our accounting, our taxation, our profession. What are the support we can take from the AI? We also have to learn that. Okay, if he not familiar, so of course he did not opt for that. So what happened? So he will not pay this 96,000 because he already opted the election. Okay, right? Here he's paying that 9%, but here the same amount is minus, so he's not paying. So this good thing, he saved this tax as a temporary. Okay, the cash flow company happy, owner is happy. So he's now the third scenario. In July 2025, we are not familiar. Okay, then we lost this opportunity. But the guy who familiar, he is okay, realization basis is there. Okay, now I'm eligible. Is this also is good? So he was getting this benefit. He's not paying. Plus, he's getting this benefit also. He's not paying 9% on this, and plus he's not paying 9% on this also. How much this 9%? So 720,000. If the person is familiar, so ultimate, how much he saved? 0.1 million if we are doing the right practice and continuously follow the taxation rules and regulations. So when we come, certain professions are require the continuous study. The CPD is a study. Okay? So now this is the whole concept that we understand, that we learn in one slide. I try to explain and sum up in an appropriate way. And below is shown the city payable analysis also, scenario by scenario. No election, realization basis, and the realization plus 173. So how much is saving? City payable, how much is saving? Because if we set this one, so he's saving more. That's why it's coming 1.1 million somewhere here. Okay. So, but actually, he do not, this much amount he will not pay. But this much amount he will not pay. Practically here we understand much better way. So if he have this, so here his saving is more. Let's assume we understand. Here the saving is less, and here is more less saving. Whatever the saving of under one scenario is the payable of the other scenario. If you here this, if I write here instead of payable, just mention the saving by scenario. Saving by scenario, because below, otherwise below field we need to swap. Hope you understand. Instead of payable or city payable saving, we can say the complete word. How much the city payable saving by scenario? So by utilizing different cases, different tax liability are different. This is the legal. This is not anything we can say that not legalized. And the same, the next dashboard. So as a summarized way, realization basis, source input is again, we collect the data from previous and we try to build up over here. Okay, original cost is this, tax return round value, this, accounting, this. So you might have looked into that and more or less the things we already learned. So this is the Emara portal. In terms of the Emara portal corporate tax return, so which area will have you adjustment. So yes, of course, these adjustment is required. And under which section, these are the schedule and the losses. Under the each section is already mentioned over here. Tax depreciation, it will be at over here, realization basis. So any particular question or any point, this is again the, I think more or less the same. And the next is the reference. If anybody would like to see the reference, so here is the reference that although the same, these reference are the the some reference coming from the accounting standard also. Okay. Thank you very much for your participation for today, and I'll looking your feedback for today's topic, because I try to cover in the very different way with practical exam. This is our session number 25, and I'm just repeating over here the session number 25. Yeah. Let me just say, and over here also. Yes, this is our topic for the ministerial scene 173 that we covered whatever the possible way, whatever along with the example. This is our session number 11, part number 25. Today date is June 7, 2026. This is the part 2 actually of the same. If I'm not wrong, we can make the, instead of 25, we might make 26. There's the correction over here. So instead of 25, because 25 is the actual topic. Yes. Thank you very much. Part number 26. This is the same topic, Ministerial Scene 173, practical example. Practical example, Excel working model we covered over here. Any question, most welcome.